A warm greetings to the lecturers, classmates, and Dr. Nuain. So today our group will be presenting the Silicon Valley Bank crisis, which will happen in the year of 2023. So basically this crisis was talking about the collapse of the Silicon Valley Bank, which it collapsed in the businesses and therefore faces the consequences of bankruptcy in the year of 2023. So before kicking off the presentation, let me introduce our group mates and the agenda of the following presentations. So here are the agenda and the flow of our presentation. Whereas the first part of the introduction of Silicon Valley Bank will be presented by Bu Kun Siang, and for the second part, Wong Wen Kai will be bringing up the journey of the SVB crisis, explaining the overall journey and the happenings of the SVB along the crisis. And the third one will be presented by Kong Jun Le to analyze the risks along the crisis. And the fourth, Lo Jun Wei will be bringing up the solutions against the risks that has been mentioned by Kong Jun Le, and following by the leadership issue that are highlighted by me, Cha Siu Lun. And lastly, the conclusion slide will be presented by Bu Kun Siang to conclude the overall presentation.
Silicon Valley Bank was founded on October 17, 1983 in California by Bill Biggerstaff and Robert Medeiros. Over the year, it became known for offering specialized banking service and expert advice to industry like technology, healthcare, and venture capital and the premium wine industry. The bank became a trusted partner for some of world-leading companies, including tech giants such as Meta and Google's, building a reputation as a critical player in the financial ecosystem, supporting innovation and investment. As of its last report, financial performance, Silicon Valley Bank managed asset value at 212 billions and issued loan amounting to 74 billions. This figure represents a 3.6% growth in loan compared to the last year. And Silicon Valley Bank managed 342 billions in client funds, highlighting its significant roles in corporate and investment banking. The CEO attributes this success to strong growth in loan, core fee income, and interest income. He emphasized the bank's healthy investment banking activity and the robustness of its balance sheet, so positioning the company as a stable player in the financial market. However, the challenge began to surface due to the strategy over reliance on long-term security and a lack of portfolio diversification. During the pandemic, the tech sector experienced a boom, resulting in the surge of deposit at Silicon Valley Bank. To utilize these funds, Silicon Valley Bank heavily investment in the maturity security and agency bonds, allocating the 121 billions, 56.67% of its total asset into this instrument, and the treasury bill alone accounted for 18 billions of this portfolio. At the same time, the bank reduced its reliance on equity loans, bringing loan allocated to 74 billions, which was 35.7% of its total assets. The Federal Reserve decision to raise interest rate post-pandemic had a profound impact on the value of Silicon Valley Bank maturity, security, and treasury notes. As interest rate increased, bond price dropped, and developing Silicon Valley Bank investments significantly, the reliance on long-term security coupled with limited portfolio diversified. The drop in the bonds attractive that caused their market value to fall below par and directly impact Silicon Valley Bank profitability and balance sheet health. Reports show that Silicon Valley Bank faced a 28.5 billion loss from its investment security, representing a 36.9% decline in income. Furthermore, the bank attempted to sell 31 billion worth of share security but only managed to realize 19.1 billions, resulting in an additional 1.8 billion loss. The lack of diversification and reliance on long-term security left the bank exposed to market volatility, eroding its financial stability. By 2023, Silicon Valley Bank's share price has plummeted by over 60%, reflecting the market lack of confidence in the bank positions. This combination of strategy misstep, rising interest rate, and the reduced income from investment in the bank, fueling the bankrupt on March 10, 2023.
Thank you, Kun Xiang. Now, we'll look at what are the causes of this crisis and how the collapse of Silicon Valley Bank happened. First of all, the primary factor that contributed to the crisis was a hike cycle of the federal funds rate in 2022. As shown in the figure on the left side, the Federal Reserve has decreased the federal funds rate to 0.25% in 2020 after the COVID-19 pandemic to expedite the economic growth. As a result, the loose monetary policy has led to a boom in the technology industry, which was the primary source of deposits of Silicon Valley Bank. Therefore, as shown in the right figure, the total assets of the bank have skyrocketed to more than $200 billion within 2 years from $71 billion in 2019, which was due to the boom in the US economy. So, to increase the yield on these funds, the bank has decided to invest heavily in long-term fixed income security, primarily in the mortgage-backed securities, which is also known as the MBS. This was the primary cause and also the beginning of the crisis. So, for your information, MBS, the mortgage-backed securities, have a characteristic of negative convexity, meaning that the duration or the risk of the asset will increase as the interest rate increases. So, unfortunately, to combat the rising inflation rate in the US, the Federal Reserve has increases the interest rate aggressively from 0.25% to 5.25% in a short period. This has caused the bank to face a total unrealized loss of 17 billion US dollar by the end of 2022, which majorly contributed by the mortgage-backed securities in the portfolio of the bank. However, these losses actually did not impact the bank immediately, as the securities are considered as held to maturity in the financial statement, which was not known by the public and also the investors. So the problem arose when the tightening monetary policy crushed the technology sector, which depositors started to withdraw money from the bank to maintain their operations. This resulted in a liquidity shortfall in the bank, which then led to the selling of security assets at a realized loss of 1.8 billion US dollar, and also the issuance of additional shares worth 2.25 billion US dollar on the 8th of March 2023. So when Silicon Valley Bank made this announcement, it created a panic environment among the depositors, leading to a herd effect, which then led to a bank run to happen. The bank faced a total attempted withdrawal of 42 billion US dollar in a single day on the 9th of March 2023. So finally, within 48 hours of the announcement, the bank declared bankruptcy and became the second largest commercial bank to collapse in the US history. Secondly, the excessive concentrated customer base of the bank has also contributed to the crisis. As shown in the left figure, the source of deposits of the bank were heavily concentrated in venture capital institutions and early-stage technology and life science companies, with more than 60% of the bank deposits were made up from the technology and life science sectors. This resulted the close linkage between the Silicon Valley Bank and also the technology and life science industry. Later, as shown in the right figure, the venture capital deal activity has dropped significantly in 2022 from more than 90 billion US dollar in volume in 2021 quarter 4 to less than 40 billion US dollar in 2022 quarter 4 due to the contractionary money policy implemented by the US government. This has caused the financial difficulties of the depositors of the Silicon Valley Bank, which then led to a drop in the deposit level of the Silicon Valley Bank as the depositors started to withdraw money from the bank. As a result, this has caused a further liquidity burden to the bank, which finally contributed to the crisis. Last but not least, the poor risk management practices of Silicon Valley Bank has also contributed to the collapse of the bank. As reported, the bank did not have a chief risk officer CRO from April 2022 until they hired a new one in January 2023. During this period, the bank faced the most serious financial difficulties as the federal funds rate started to hike. This poor practice has led to the inefficiency of the risk management team of Silicon Valley Bank, resulting in the inadequate risk hedging in the portfolio securities, which was the primary factor of the crisis. Now, we have explained that what are the main factors of the crisis. Next, I'll pass my teammate Junle to explain further on the risks faced by Silicon Valley Bank. Thank you.
Moving on, I'll be discussing on the risk faced by Silicon Valley Bank. The first one will be liquidity risk. So what is liquidity risk? Liquidity risk is the risk of loss arising from the inability to fulfill financial obligation in full and also on time. So take for example, when the bank faces liquidity risk, it usually indicates that the bank is unable to sell or convert liquid assets into cash without huge losses. And according to an article by Xia and Zhang, Silicon Valley Bank was actually exposed to liquidity risk. By examining Silicon Valley Bank asset and also liability structures, a study has shown that Silicon Valley Bank has a significant mismatch between its short-term loans and also long-term investment. Therefore, as the Fed increases the interest rate leading to tightening of market liquidity, this mismatch of asset and also liability eventually sets Silicon Valley Bank to be in extremely high liquidity risk level. So after all, the Silicon Valley Bank downfall occurs when investor and depositor plans to withdraw their funds. Thus, the inability of Silicon Valley banks to convert its long-term investment into liquid cash leads to the bank run situation. And next up, we are going to talk about the second risk, which is the interest rate risk. So what exactly is interest rate risk? Interest rate risk is the exposure of bank current or future earnings and capitals to negative effect in the interest rate. And interest rate risk is mainly caused by the volatility of interest rate and also mismatches between interest maturity date on asset and also liabilities. So as for Silicon Valley Bank case, the bank collapsed due to the underestimation of interest rate risk on its heavy position in long-term bonds. This happened as Silicon Valley Bank started to put majority of its new deposit in long-run treasury and also mortgage-backed securities, while ignoring the effect of fluctuation in interest rate on bond price. So eventually, when the Federal Reserve announced an aggressive rate hike, the 10-year treasury note rose from 1.64% to 3.97%, resulting Silicon Valley Bank's long-term portfolio investment to suffer significant loss. Hence, a bank run occurs when Silicon Valley Bank failed to issue shares to increase capital and creating a panic state in the market. That's all from me. I will pass on to Junwei for the solution part.
So thank you, Junle. So next, I will continue to discuss about the solution that Silicon Valley Bank can solve the causes. So firstly, Silicon Valley banks can diversify their asset portfolio by investing in a mix of short-term and long-term security, as well as a higher yielding asset. This would have reduced its exposure to interest rate risk and provided a more stable income stream. Moreover, SVB could have considered investing in a diversified portfolio of stock across various sectors and geographies. By By implementing a more diversified investment strategy, SVB could have been better prepared to withstand economic shocks and interest rate fluctuation. It's important to note that diversification does not eliminate risk, but it can help to manage and spread it across a broader range of assets. Next, one of the main reasons that SVB collapsed is mainly due to their excessive concentration of their customer base in the technology industry, with more than 60% of their bank deposit being made up from technology and life science sector. So we think that they should focus on diversifying on their customer base to other sector beyond technology sector to mitigate the risk associated with a concentrated depositor base, such as targeting high growth sectors such as healthcare, biotechnology, renewable energy, and manufacturing. Other than that, as Silicon Valley Bank should focus more on mature company or larger corporations that have proven record with a more stable revenue stream which are less likely to default on their loan. Silicon Valley Bank can also implement a comprehensive approach to risk management. Firstly, strengthening stress testing is essential. By simulating various adverse economic scenarios, banks can identify the potential vulnerabilities and take proactive measures to mitigate risk. Regular stress tests should assess the impact of factors such as interest rate fluctuation, credit losses, and market volatility. Secondly, enhancing liquidity management is crucial. Banks must maintain a sufficient liquidity to meet potential deposit withdrawal and other obligations. This involves careful monitoring of cash flow, diversifying funding sources, and establishing strong relationships with central bank and other financial institutions. Thirdly, effective interest rate risk management is important. Silicon Valley Bank should implement strategy to mitigate the impact of interest rate fluctuation on their profitability and capital adequacy. This may involve using interest rate derivatives by adjusting the maturity profile of asset and liability and conducting regular interest rate sensitivity analysis. Finally, a strong risk culture must be fostered within the organization. This involves creating a culture of risk awareness, accountability, and transparency. Employees at all levels should be empowered to identify and report potential risks. By implementing this solution, SVB can significantly improve their risk management practices and build a more resilient and sustainable business model. So, after the Silicon Valley Bank collapse, US Congressman Sean Casten introduced the Chief Risk Officer Enforcement and Accountability Act. So, the purpose of this legislation is to prevent future banking crises by mandating that large banks have a dedicated chief risk officer. The absence of a chief risk officer at Silicon Valley Bank during a critical period preceding its failure was identified as a significant oversight. The bill seeks to address this issue by requiring large banks to appoint a chief risk officer and notify regulator within 24 hours of any vacancy in this position. Additionally, the bill imposes strict timeline for filling such vacancy and penalties for non-compliance. By establishing a clear regulatory framework for chief risk officer position, Caston bills aim to strengthen risk management practice within the bank industry. As a result, this can help to prevent future bank failures and protect the interests of depositors and the broader economy. So that's all for my part, and now I will pass it to Chia Shulun for further explanation on the leadership issue of Silicon Valley Bank.
Well, thank you, Junwei and the teammates for the comprehensive information. As we all know that leadership in a firm, especially the listed companies and the public institutions, is relatively crucial. The leading spirits of the executives and the management teams will directly impact the performance of the companies as well as the wealth of the shareholders. So without further ado, let's talk about the highlighted leadership issue along the SVB crisis. Firstly, let's talk about the resignation of Laura Izurieta. In the April of 2022, she has withdrawn herself from the position of Chief Risk Officer of Silicon Valley Bank. As we all know that financial institutions such as Silicon Valley Bank and the other banks are heavily dependent on the financial investments, such as the investment in financial securities and properties and so on. Therefore, risk management department in this case are acting a pivotal role to mitigate the risk. As we all know that every kind of investments are come with risk, and we should not be able to ignore it but to mitigate it. So with the resignation of Laura Izurieta, it has led to a blank of leadership in the risk management department and causing SVB to be exposed in a high risk of investment due to the weak diversification in the investment portfolio. So other than that, the lack of leaderships are also leading SVB to a failure of these investment decisions. One of the most famous instances were the scenario that the executives of the CEO of the SVB announced a launch of action to short the securities valued as $21 billion, and these actions had led to a realization of a total loss of $1.8 billion. So after the news were announced, it has launched the panic among the depositors and investors, and therefore eventually led to a bank run in major publics. So in this case, we may see that the lack of considerations among the leaders, among the executives, are slowly leading the companies to the crisis of collapsing in this case, where they are not well considering and they are not well concerned with that. So as conclusion, these two issues, as I mentioned above, has demonstrated clearly how the leadership may cause the adverse impact to the companies, and therefore it may cause the collapse of the company at the worst scenario in this case. So that's all for my part. Let's pass it to the next presenter.
Thank you, Chasulun. So now I make a conclusion. The failure of Silicon Valley Bank demonstrates the impact of risk management practice and a lack of investment diversification across the various sectors. Silicon Valley Bank focus on the long-term fixed income security left it vulnerable to change in interest rate when the Federal Reserve raised the federal fund rate aggressively. So this result in a decrease in the market value of this security and the substantial unrealized loss. For Silicon Valley Bank, the situation was due to Silicon Valley Bank high number of depositors coming from the technology and life science, accounting of over 60%. This sector were hit hard by the condition at the time. Furthermore, the Silicon Valley Bank lack of a chief risk officer for 8 months. So its ability to take this difficult efficiently. This lead the loss of trust among depositors, eventually trigger a bank run that culminate in a bankruptcy. To avoid the repeating the mistake in future and enhance the stability, I have two suggestions. The first one is reduce the number of loan issue. adopt a more cautious and selective lending strategy based on the bank financial resource to minimize the risk and ensure sufficient liquidity during economic downturns or unexpected market conditions. The second is increase external funding sources. The bank should explore obtaining more external funding through interbank loan of bond insurance to strengthen its resilience. This will provide a solid foundation to withstand a large-scale withdrawal and market volatility, helping to restore the trust among investors and stakeholders. So this is our presentation. Thank you.
Well, that is all for our presentation. We deeply appreciate for your attention along the presentation. Thank you.